Well, from mergers to demergers, it's been quite a journey for Vedanta over the last decade. The conglomerate made headlines when it announced its grand plan in 2012 to merge all of its Indian firms into one entity. It was all about consolidation, bringing businesses like Sterlite Industries and Sesa Goa together. Now, fast forward to 2023, and the tide has turned. Anil Agarwal, the visionary behind Vedanta, has decided to split the conglomerate into six distinct companies, each focused on specific business lines. Well, it's a full circle moment, and the goal unlocking value for investors. But here's the $1 million question: is this demerger really a value booster? And can it help Vedanta dodge its debt woes? Watch this video as we try and look for answers. But first, don't forget to like and share this video and subscribe to the Money Control YouTube channel. Now, currently, Vedanta Limited operates business units across India and Africa. The consolidated structure consists of business units including oil and gas, metals and minerals, power and technology. The new Vedanta will house semiconductor and display manufacturing plus Hindustan Zinc, a cash cow. The rest will be carved out into 5 units. Here's how the demerged businesses will look like. The currently listed Vedanta entity would hold the 64.92% stake it has in Hindustan Zinc, along with the upcoming semiconductor and display business and the stainless steel business. A substantial chunk of Vedanta's operating profit in financial year 2023 came from Hindustan Zinc, followed by the oil and gas business. Vedanta Aluminium will be housing the aluminium business and the 51% stake it holds in Balco. Vedanta Oil and Gas will house KN India. Vedanta Base Metals will include the copper and zinc international business, and Vedanta Steel and Ferrous Metals to house the domestic iron ore business, Liberia assets and ESL Steel. And lastly, the Vedanta Power will include all the power assets. Now, every Vedanta shareholder will receive one share of each of the new entities. It's a complex process requiring approvals from minority shareholders, lenders, and authorities. The timeline about 12 to 15 months. Anil Agarwal, Vedanta's chairman, believes that these demergers will empower each unit to pursue its goals, align better with customers, and tap into market trends.
This is a win-win for everything. Two-third voting will be from our side, Vedanta Resources, which we confirm that they will vote in this favor. And I have no doubt this is to create a great value for everybody, including the government, including all the shareholder. For me, my shareholders are very important. Those opportunities will be phenomenal, and it will be very interesting for our shareholder. Pure play, somebody want to retain all this. Instead of one share, they will have a 6 share now, and they can have a more flexibility.
Nuvama, which is a domestic brokerage, sees Vedanta transitioning from a diverse producer to a pure play asset owner, meaning Vedanta is no longer that one company that houses diverse businesses. Each business will now be a separate listed entity so that investors get a chance to choose the business they want to invest in. But does it really add value for shareholders? Well, yes, in the sense that you have that choice to invest in the businesses that you like and stay away from that do not appeal to you as an investor. But beyond that, the big issue with the Vedanta Group has been the mountain of debt the group is saddled with. Currently, the debt at consolidated level stands at $9 billion, 60% of which is on the books of Vedanta. While analysts see the move helping the company eventually, they remain skeptical about its impact over the next few months, especially as they also await details of how debt among each of the businesses will be distributed. This is exactly what Nuvama feels. It believes that Vedanta's cash flows are not sufficient to upstream the dividend to Vedanta Resources unless it assumes debt on its books. So how can this demerger really help? According to Deven Choksi, the demerger will break up this mountain of debt into smaller parcels based on the verticals. With the consolidated business, the company had concentration of the debt in the books of Vedanta Limited, and this move to split it into more digestible chunks for the lenders. The hope is that the demerger might also boost Vedanta's valuations overall, as the split may result in a run-up in the shares of the listed entities. If that indeed happens, with higher valuations for the separate entities, the promoter could access more funds based on their holdings. They might even consider selling a demerged entity in order to salvage the more valuable asset the group may want to hold on to. So what assets could they really sell or monetize?
We have a phenomenal response for our steel and iron ore sale, which can be taken care of the entire debt. And we believe that by March, we'll be able to complete the transaction too. Anybody want to produce green steel? This is the only site where we have a gas availability, complete infrastructure availability. As somebody want to produce 15 million ton internationally, people are very keen to have some step into India. So this is the best opportunity for them.
Another possibility is the proposed demerger of Hindustan Zinc's silver and recycling businesses. Now, this will mean that the company will have to sell its entire silver unit, which does not make sense according to analysts. Besides, Rakesh Arora, founder of GoIndiaStocks.com, sees little possibility of Hindustan Zinc restructuring going through, given the fact that the government still holds 29% stake in the company. He says that the silver and recycling businesses, that the two businesses that the company is looking to demerge, are smaller in scale compared to the zinc business, so it may not add up too much. Meanwhile, time is of essence. Vedanta Resources has pending payments of around $4 billion from now until financial year 2025. The promoter entity has cash-generating tools like dividend from Hindustan Zinc and Vedanta Limited, potential stake sales in Vedanta Limited, and also brand freeze from Vedanta and its subsidiaries. Rakesh Arora is of the view that Vedanta's promoters can handle most of the payments due in 2024. But 2025 is a challenge, and the rolling over loans and deposits would be one option. There's talk of the debt exchange, but the details are yet to unfold. But credit rating agencies remain skeptical. Both Moody's and S&P have downgraded Vedanta Resources due to debt refinancing concerns. Still, some experts maintain that the demerger may eventually be credit enhancing for bondholders, as the separate entities may be able to raise cash more easily. So could this be one final gambit of the group to overcome its debt-related challenges? Well, got to wait and watch. For more such videos, keep following Money Control.